Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at CIFR mining.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis of CIFR mining.
Yeah, let's do it.
The high-level story here is really this radical transformation.
From a crypto miner to something else entirely.
Exactly, into an AI infrastructure giant.
Yeah.
And to really get the speed of that change, we have to start with their Q3 2025 financials.
Which were, frankly, pretty incredible.
An operational masterclass, really.
It felt like more than just a good quarter. It was an acceleration event.
That's a good way to put it. They reported really robust revenue growth, hitting $72 million.
And what stands out to me is just the scale of that ramp up.
Right.
It's a massive 65% increase quarter over quarter from the $44 million they did in Q2.
And that acceleration, that's the key insight. It tells us two things happened at the same time.
Okay.
One, of course, was the higher Bitcoin price environment during the quarter. That helps.
Sure, that gives you a tailwind.
But the more vital factor, I think, was the huge increase in their own operational capacity.
Right, getting their new sites running.
Specifically their Black Pearl facility and all those new mining rigs they finished deploying earlier in 2025.
And you can see that return on investment immediately in the production numbers, can't you?
Oh, absolutely. They mined 629 Bitcoins in Q3.
Which is a substantial leap from, 434 in Q2.
That's the one.
Huh.
And when you see a 65% revenue jump that's backed up by that kind of tangible increase in output, it just signals that the capital they're deploying is working, and efficiently, too.
Okay, so they're spending money, but it's working.
Yep.
What about profitability, though? I mean, with all that spending.
That's what's so fascinating. Despite all this really aggressive capital expenditure, the profitability figures are also showing strong signs of improvement.
So they're getting closer to that inflection point.
They really are. Their earnings per share came in at 10 cents.
Which is a 34% increase over Q2's 7 cents.
Right. And yeah, I did narrowly miss the analyst consensus, but for me, the growth trajectory itself is what matters most here.
I think the most important financial takeaway for me, though, has to be the net loss figure.
Ooh, let's break that down.
We have to look at the GAAP net loss, the formal, big picture number that includes all the non-cash stuff, like heavy depreciation.
And in Q2, that number was huge.
It was a whopping $46 million loss. In Q3,
It just shrank.
all the way down to just $3 million. That is a near complete turnaround in operating efficiency in a single quarter.
A $43 million reduction in net loss. That suggests they're effectively covering their operating expenses and just, rapidly closing that gap to profitability.
But this is where the story pivots, isn't it?
This is it.
They aren't just getting better at mining, they're using those assets to shift into a totally different business.
Exactly. The big story for you as an investor is this strategic pivot toward high-performance computing, or HPC.
And when we say HPC, think of the raw infrastructure you need to run huge AI models and handle massive amounts of data.
That's it. They are actively positioning themselves not as a miner that just happens to own some data centers,
But as a major data center and computing operator.
and this pivot is absolutely central to the expectation of accelerating revenue growth going forward.
And this strategic move, it's not just based on hope, right? It's built on a real asset.
It's built on an infrastructure asset that creates a huge competitive moat. We are talking about their leverage of a 3.8 gigawatt power pipeline in Texas.
Which is just an enormous amount of power, one of the largest pipelines in the whole industry.
But why does that specific asset create a moat? I mean, lots of companies buy power. What's so special about this?
It really comes down to vertical integration and scale economics. In Texas, having that vast power capacity gives them incredible leverage.
So better pricing.
It means they likely have access to long-term, very advantageous power purchasing agreements, or even direct connections to the grid infrastructure.
And for an HPC facility, power isn't just an expense.
It's the primary input cost. It's everything.
So having 3.8 gigawatts means they can scale their AI and data center capacity faster and probably cheaper than their peers who are, scrambling to find that kind of power.
So they're basically turning into a utility player that specializes in computational heavy lifting.
A very good way of putting it. And that foundation is what supports their major partnerships.
Right, the big names. We know they have deals with titans like Amazon Web Services, AWS, and also with FluidStack and Google.
And these partnerships are transformative. They instantly put the company right in the middle of the booming AI computing sector. For you, the key takeaway is stability.
Long-term contracts.
Exactly. These deals often involve long-term hosting contracts, which provide stable, predictable cash flow. And that's a crucial de-risking move.
So it reduces their reliance on the crazy price swings of cryptocurrency.
Massively. They're essentially using Bitcoin mining as a sort of immediate cash generator on their existing power capacity.
While they build out the massive long-term and high-margin AI business on the same backbone.
It's a brilliant strategic trade-off.
It is, but growth at this kind of scale is immensely expensive.
Which brings us to their capital structure. How are they funding this giant leap?
Well, they've been incredibly active in the debt and convertible markets to, bolster their balance sheet.
We saw two massive raises.
A $1.3 billion convertible offering.
And then a $1.4 billion private offering of 7.125% senior secured notes that are due in 2030.
That's billions of dollars being raised very, very quickly.
And just to simplify those complex terms for a moment, the secured notes are basically traditional debt. They're secured by company assets, which means lower interest, but, fixed large payments.
And the convertible offering is different.
It's different. It gives investors the option to convert that debt into company stock later on, if the stock does well.
So both methods let them fund the construction of that massive Barber Lake HPC data center without, immediate massive shareholder dilution.
It's smart financing, for sure, but it does introduce a major risk factor that we just can't overlook.
All that heavy investment, that focus on future scale, it means current profitability is being aggressively sacrificed.
And you can see that clearly in their operating margin. The EBIT margin is currently sitting at a negative 98.1%.
Wow. That number on its face is shocking. I mean, if you saw that in a mature company, it would be a huge red flag, a disaster.
It would. But we have to provide the context here, which is critical. This is actually pretty typical for a company that's aggressively scaling its infrastructure in the AI sector.
So they're just pouring money into physical construction, specialized hardware, and grid connections.
That won't start generating maximum revenue for another few quarters.
It's the classic high-stakes venture capital model, but applied to a public company.
That's right. They're willing to pay the highest price right now, that nearly 100% negative operating margin, to guarantee future market dominance and lock in those contracts with tech giants before competitors can catch up.
And the market's assessment of this trade-off is reflected in their valuation.
Definitely. Despite that really stark negative operating margin, the price-to-sales ratio is extremely high. It's at 56.35 right now.
So that tells us investors are looking far beyond Q3 or Q4.
They are placing extreme confidence and really a lot of value on the future revenue they expect from that Barber Lake facility.
Okay, so moving beyond the financials, let's look at the price action and the market momentum.
The stock has shown a strong, sustained bullish trend all through 2025.
It's traded in a very wide 52-week range, too. I mean, from $1.86 all the way up to $25.52.
That kind of volatility really confirms the high-growth, high-risk sentiment around this whole transformation.
And after the Q3 earnings, we saw that immediate surge, pushing the price up to $23 in pre-market trading.
Technically speaking, the stock is showing very clean, bullish behavior. It's consistently setting higher lows and higher highs, which suggests a pretty reliable upward path.
So for any technical traders listening, the key levels seem pretty clear.
Strong support seems to be holding around that $18.34 mark, and the latest move up just shattered the resistance at $23.
Which confirms that upward momentum is continuing.
And it's trading healthily above both the 50-day and 200-day moving averages. That's, the textbook definition of a sustained upward trend.
So the technical picture really aligns with the positive market sentiment that's being driven by this whole AI and HPC narrative.
It does. Institutional inflows have been increasing substantially. Big money is clearly signaling its belief in the strategy.
They believe this company is a critical infrastructure play in the AI boom.
This is where the picture gets a little more nuanced. We have to talk about the insider activity,
which can often be misinterpreted.
Very easily. We've seen a noticeable lack of recent insider buying throughout 2025, which, given the stock's strength, might raise a few eyebrows.
Instead, the focus has been on selling, specifically related to compensation.
Right. So in November, for example, the CEO settled over 1.4 million performance stock units, converting them to common stock.
And then right after that, he disposed of over 700,000 shares and gifted another 238,000.
On top of that, a company officer sold over 170,000 shares under a pre-established 10b5-1 selling plan.
Okay, let's just quickly clarify what a 10b5-1 plan is for you. It's a pre-scheduled trading plan.
And it's put in place when the executive doesn't have access to private material information.
Right. It's often used for things like tax management, diversifying assets, or covering expenses when stock vests.
So while the sheer volume of selling might look concerning at first glance, the context, compensation settlement and pre-planned sales, suggests it's less about a lack of confidence.
And more about liquidity and tax planning.
Still, it does create a bit of a mixed picture. You have high institutional buying on one hand and high insider selling on the other.
It means you probably need to prioritize the strategic narrative and the future growth over those immediate insider signals, given what we know.
So, with all that said, what are the near-term catalysts we should be watching for? What could trigger more price movement in the next, say, 0 to 3 months?
Operationally, the focus is on a few key dates. First, the Q3 earnings release on December 9th, 2025.
And that will give us crucial detail on the Barber Lake financing and hopefully some early operational results from the HPC shift.
And then beyond company dates, you have broader market mechanics.
Like the major ETF index rebalance at the end of December.
And then the institutional buys and fund rotations that always seem to happen at the start of the new year, around January 2nd, 2026.
Those events can force large passive funds to buy shares, which creates significant volume.
And the operational triggers are maybe the most exciting part.
I think so.
Yeah.
We're anticipating announcements of new product launches and partnership deals in the HPC sector.
Any new contract with a major cloud provider or enterprise client will be seen as immediate confirmation that this whole pivot is working.
And of course, there's no shortage of speculative buzz.
There never is. We're hearing these persistent rumors of more strategic partnerships with other major tech companies.
Maybe hyperscale hosting or other cloud providers to sort of round out their existing portfolio.
There's also some fascinating chatter specifically about the Barber Lake facility itself,
Yeah, the speculation suggests that construction and deployment might be running ahead of schedule.
which could mean a higher than guided initial hash rate or computing capacity.
And if that happens, it would translate directly into a huge upside surprise when they eventually release Q4 guidance. It would signal superior execution.
So looking even further out, the longer-term drivers really revolve around scale and expansion.
Right. We're talking about potential M&A activity, either them acquiring smaller strategic assets.
Or, given their massive power infrastructure, they could become an acquisition target themselves for a tech giant looking for immediate scale.
And also, any entry into new geographic markets would signal sustained upside potential far beyond just the next couple of quarters.
So to wrap up the investment thesis here, this company is making a very decisive and very expensive move.
They are successfully executing a high-growth pivot toward the explosive demand of the AI and data center sectors, and they're leveraging substantial, unique infrastructure and capital to do it.
And while they carry that burden of high investment costs, that negative 98.1% EBIT margin, the market is currently giving them full credit for future success.
It's a high-stakes trade. The core question for you is whether you believe their massive, unique power asset is enough of a moat to ensure they capture a big piece of the AI pie.
Before their substantial debt requires them to slow down or pivot again.
We hope this analysis of CIFR mining was useful for your portfolio decisions. Don't forget to subscribe and hit the like button if you want more market talks like this from Smart Wealth with Joshua.